Okay, if you've looked at the market lately, you might be feeling a little twitchy.
Yeah.
We are seeing some seriously choppy price action right now. Market volatility is definitely up,
Hmm.
and it feels like every single headline triggers some kind of sharp move, making it incredibly tempting to, try and guess the next drawdown.
It is. It's hard to settle on a direction when the boat keeps rocking this much.
Exactly.
It's a completely understandable feeling, honestly. But what we're seeing, it's actually a pretty classic characteristic of a healthy, maybe maturing bull market.
Healthy. Feels a bit rough.
Well, yeah, but if you look back at history, especially the later stages of these really big rallies, you almost always get these short, sharp pullbacks. Think about, say, 1998 and 1999.
Okay.
We had intense volatility, lots of rotation, long before the actual peak hit in March 2000.
Yeah.
So our analysis suggests really, instead of fearing this latest dip, you should probably take it in stride. Look past the short-term noise.
All right, so we're not going to let the choppy waters scare us off.
Hmm.
But what gives you that confidence that these dips will actually be bought and the long-term trend is still, positive?
Yeah.
Why should we look past what feels like some genuine, pretty widespread anxiety out there?
Because there are two massive structural macro forces working right now. And they seem demonstrably stronger than the short-term jitters.
Okay.
The central idea we're really going to drill into today is that Fed rate cuts, well, they pack significantly more punch when they happen against a backdrop of strong earnings growth.
Right, that combination. And that's exactly our mission for this deep dive then, to unpack the evidence showing that this mixed policy easing plus profit power creates an almost irresistible historical signal. And for you listening, the key takeaway right out of the gate should be pretty clear. The case to buy the dip, it's actually strengthened when you couple that easing Fed policy with a really robust earnings picture.
Exactly. When investors get both things, the certainty of accommodative policy, like the Fed saying, hey, we've got your back, and the prospect of increasing future value from strong earnings, well, the psychology just shifts immediately.
Yeah.
This combination fuels outperforming returns later in the cycle. It's driven by that intense fear of missing out, FOMO.
Oh, FOMO.
Yeah, and that ensures those short-term drawdowns get bought up pretty quickly by capital that's just been waiting on the sidelines. So to really understand why this powerful synergy exists, we first need to look closely at the Fed side of things. Why are they cutting rates right now?
Good question.
It's purely a response to what we're calling bifurcated economic growth.
Yeah.
We've got strong resilience in some pockets, but genuine softness in others.
Okay, let's start with those sluggish areas then, the ones that actually prompted the Fed to start easing policy.
Right. The primary areas of softness that seem to concern the Fed involve the labor market and interest rate sensitivity. The labor market is softening, not necessarily through big mass layoffs, but more due to this intense corporate focus on labor efficiency and automation. Often AI-driven stuff.
Right, efficiency gains.
Exactly. And at the same time, sectors sensitive to higher borrowing costs, think housing, commercial real estate, they remain noticeably sluggish, still feeling the pinch.
And just to ground us right now, the Fed's already cut rates twice in September, right? Bringing the Fed funds rate down to what, 3.875%?
That's correct, 3.875%.
Yet those resilient parts of the economy, look at the Atlanta Fed's latest Q4 GDP nowcast. It's clocking in at a surprising 4%. That seems pretty strong.
It does.
So if growth is that resilient, why do the sources suggest the Fed is still committed to cutting further?
Yeah, that's the critical tension, isn't it? We have to address that. The market is clearly pricing in, anticipation for another 75 to maybe 100 basis points cut by the end of 2026. The Fed is essentially managing the risks in the system, those slow-moving parts, to make sure they don't drag down the high momentum parts. They're cutting rates not really because of a present crisis, but because they're looking ahead. They're reacting to early cracks, particularly in areas like smaller businesses, regional banks may be exposed to commercial real estate.
So it's forward-looking, proactive, not reactive.
Precisely.
But the counter momentum is what makes this whole setup so unusual, though. I mean, we're talking about this massive AI infrastructure boom, and also, critically, a surprisingly resilient high-end consumer.
Absolutely.
Those two forces are providing a huge counterweight, aren't they? Bolstering the overall economic picture, keeping that GDP number healthy despite the softer labor data.
They really are. Although while that domestic momentum is strong, we do have to acknowledge a specific headwind our research flagged: tariffs.
Okay.
Customs duties actually became a significantly larger headwind in Q3 than they were in Q2.
How much larger?
Well, in Q3, total customs duties tallied about $93 billion. That represents a pretty substantial 33% increase relative to the second quarter.
Wow, 33% quarter over quarter. Why the big jump? Does the research offer any insight there?
The acceleration suggests maybe more concentrated enforcement, or perhaps a change in targeted import duties, specifically hitting goods flowing from key trading partners.
Okay.
We don't have the specific commodity breakdown right here, but the impact is clear. Trade policy is definitely applying noticeable pressure on corporate inputs. Even while domestic consumer spending holds up, it's a drag on the efficiency side for companies.
Got it. Another cost pressure to manage. Okay, let's pivot then and focus on that second massive force, the earnings engine. Because the reason the market can, absorb these pullbacks seems simple. Stocks tend to do spectacularly well when profit growth holds up.
Absolutely.
And right now, the primary engines of that profit growth seem to be these twin forces: AI adoption and, of course, the performance of the Mag 7.
The Mag 7, the Magnificent 7. Yeah. Those leading mega-cap tech firms that are driving the bulk of the market's performance and, crucially, the bulk of the AI capital expenditure. They're just a concentrated core of growth right now.
And their success is driving pretty impressive numbers across the whole S&P 500, you're saying.
It is. We can point directly to operational efficiency. Yeah. S&P 500 net profit margins are currently quite impressive at 12.8%.
12.8%. How does that compare?
Well, to put that in context, that's significantly above the 5-year average, which is around 12.1%.
Right, so better than average.
Definitely. It shows management teams are doing a really remarkable job navigating those cost headwinds like the tariffs we just mentioned.
Yeah.
While sales growth stays robust, that indicates strong pricing power and controlled expenses.
So that's not just margin maintenance. That sounds like real operational leverage in action.
It is, absolutely. And the outlook is perhaps even more telling. The 12-month forward S&P 500 earnings figure, it's been steadily revised up. Yeah. It now stands at $299.60 per share. That represents a projected 12.8% year-over-year growth.
Wait, so profit margins are at 12.8% now, and future growth is also forecast at 12.8%.
Correct. That's a bit of symmetry there. And remember, that 12.8% growth forecast is nearly double the long-term historical average growth rate for the S&P 500, which sits closer to, say, 7%.
Wow, double the average.
The acceleration is massive.
What's fascinating here, though, is how this momentum seems to continuously catch analysts off guard. We saw this specifically in the Q3 data you mentioned. At the start of the quarter, analysts forecasted, consensus EPS growth of 7.9% and revenue growth of 6%. They seemed pretty cautious.
They were, but the reality was far better. With about 2/3 of the S&P 500 reporting by the end of October, actual EPS growth came in at 10.7%.
10.7 versus 7.9 forecast. Big beat.
Huge beat. And sales growth hit 7.9%, also beating the 6% forecast. And look, this significant earnings upside, it's not some new fluke either. No. The historical data shows that, get this, 74% of S&P 500 companies have beaten street EPS estimates over the past decade.
74%. Wow. Why the perpetual underestimation then? Are analysts just structurally cautious, or is maybe the pace of technological change, specifically this AI boom, just moving too fast for their traditional model?
It's likely a combination of both, really. Traditional forecasting often smooths out volatility, right? And it relies heavily on backward-looking data.
Makes sense.
But when you have a revolutionary technology like AI driving massive capex and immediate efficiency gains, often confined to just a few dominant players, well, the pace of change just outstrips the models. Analysts end up playing catch-up because the historical playbook doesn't really account for this kind of concentrated, radical productivity leap.
So the past isn't a perfect guide for this specific future.
Not entirely, no.
Okay, so let's tie these two powerful threads together now. We have the Fed easing rates to manage risk, which is historically a powerful tailwind for markets. And we have earnings growth that is well above average, powered largely by technology and efficiency gains. This sounds like the cocktail to supercharge markets that our sources were talking about.
It really is. And what's particularly rare about this moment is the policy context. The Fed is actively cutting rates at a time when earnings growth is this robust.
That's the key difference.
Yes. Typically, the central bank only begins easing when the economy is already in distress. Profits are collapsing. In those cases, the cuts are reactive and often kind of ineffective against a broader decline.
But these cuts, as you said, are proactive. They're targeted at specific weaknesses, while the overall corporate income statement is flashing green.
Exactly. And that makes the historical signal incredibly powerful. The research we looked at analyzed market performance going way back to 1977. It focused specifically on periods where the Fed was easing and earnings growth was above average.
Which is exactly our current situation.
Precisely.
So what did that historical combination yield? What were the returns?
In those specific periods, the S&P 500 gained an average of 12.4% per year.
12.4%. That is a truly significant average rate of return.
It really is.
Now contrast that with easing cycles where profit growth was below average. What happened then?
Yeah, good comparison. In those negative profit scenarios where the Fed was easing but earnings were weak, the market only saw about half as much gain, roughly 6% on average.
Only 6%.
Yeah. So the data provides a very clear blueprint. Rate cuts, when combined with strong corporate profit expansion, create this robust historical momentum engine for strong equity returns. It basically transforms policy easing from what might look like a panic signal into an opportunity signal.
Okay, that's a powerful message. Fed easing plus strong earnings, historically strong returns.
However,
Yeah.
and this is really important, this bullish macro backdrop, that 12.4% average annual gain, it comes with an absolutely critical caveat that listeners have to understand.
Okay, what's the catch?
This favorable scenario does not mean all stocks are just going to climb together. In fact, because of the very concentrated nature of the profit drivers we talked about, AI, the Mag 7 selectivity is everything right now.
Ah, okay. So it's not a rising tide lifting all boats situation. This is where we need to dive into that concept of stock dispersion, right? Which measures the spread between the winners and the losers.
Exactly. And dispersion is currently near all-time highs.
Near all-time highs.
Yes. This means that while the headline S&P 500 index might be rising nicely, thanks mostly to those large concentrated names, the vast majority of individual stocks are actually struggling. Winners have absolutely soared, but the losers have tanked. It's created immense capital concentration.
And we have hard data to back this up too, don't we? I think I saw only about 51% of S&P 500 companies are currently trading north of their 200-day moving averages.
That's the number, just 51%.
That number should probably alarm anyone who believes we're in some kind of broad-based rally.
It absolutely should. I mean, if the macro trend were truly lifting all boats equally, that indicator, that breadth measure, it would be well into the 70s or 80s.
Right.
The fact that nearly half the market is technically in a structural downtrend, trading below its long-term average, confirms that this is absolutely a, quote, real stock pickers market. The macro signal is strong, yes, but the micro environment demands intense focus. Selection is key.
Okay. So despite the fantastic policy and earnings signal, the rising tide is definitely not lifting all boats. Given this high dispersion, what does following the flows really mean in practice? How can you, the listener, identify those high-quality stocks that are seeing that institutional support?
Yeah, good question. Following the flows essentially means understanding institutional conviction. Big money players, pension funds, endowments, large asset managers, they operate differently than the retail crowd.
How so?
Well, they generally have longer time horizons, they do much deeper due diligence, and they need significant liquidity to build positions. Therefore, when that institutional money commits to a stock, it tends to create sustained upward pressure and noticeable volume patterns.
Okay, so we're looking beyond just simple price movement then.
Yes, definitely. You're looking for things like high relative strength compared to the market, coupled with high volume breakouts or maybe sustained accumulation phases where big players are clearly buying.
Right.
You want to align your portfolio not with weak names hoping for some miracle turnaround, but with stocks that are already demonstrating superior operational execution, the kind that analysts keep underestimating, as we discussed, and are simultaneously seeing demonstrable capital commitment from serious long-term investors. Good results tend to happen when you follow that verifiable institutional data instead of just chasing weak names based on hope or, rumor.
Follow the data, not the crowd or the hope.
That's a good way to put it. So, just to briefly synthesize our findings here, we are currently operating under what looks like a historically bullish macro backdrop. We have the relative certainty of Fed easing targeting specific economic softness, coupled with really impressive high-velocity earnings momentum, driven overwhelmingly by that AI infrastructure investment and the Mag 7.
Okay. And the key action point then for you, the listener, is this. As the Fed likely keeps easing and those profits power ever higher, you really need to lean into the winning stocks.
Yeah.
That means focusing on high-quality names that are clearly seeing the strongest institutional support. Follow the data, follow the flows, especially in this highly selective market.
Exactly. And that leaves us with maybe a provocative thought to end on, something for you to consider.
Okay, let's hear it.
Given that the historical signal we discussed, that 12.4% average annual gain, is based purely on the combination of strong earnings and easing policy, will the sheer strength of this macro synergy eventually just overwhelm the extreme stock dispersion we see today? Will it finally start lifting more boats?
Interesting question.
Or, alternatively, because the earnings strength is so heavily concentrated in just a few technological giants, will high selectivity and high dispersion remain the dominant market factors moving forward, effectively, neutralizing some of the impact of that broad historical signal?
So will the macro eventually win out over the micro, or will the concentration keep dispersion high?
Precisely. You really have to consider how those powerful top-down forces are going to interact with the intense bottom-up pressure on individual stocks over the next, say, year or two. It's a fascinating dynamic to watch.